Are you a homeowner or thinking about buying your first home? You might be sitting on tax benefits you didn't even know existed. Stick around, this could save you thousands. Welcome to the Freedom Group channel, where we help individuals and business owners make smart financial moves that build wealth and security. Freedom Group is made up of 3 companies proudly serving the community for over 20 years in taxes, accounting, and insurance, financial planning, and real estate. We're here to help you with every step, both business and personal. But before we dive into the tax benefits, I need to explain and make sure you know the difference between taking the standard deduction versus itemizing deductions. The IRS gives an automatic deduction called the standard deduction that is based on your filing status. For 2024, if we take a look at the filing status standard deductions, for single people, that is $14,600. If you're married filing joint, that standard deduction is $29,200. If you're head of household, it would be $21,900. So instead of taking this standard amount, you can itemize your deductions instead on your U.S. federal income tax return if your total of your itemized deductions are greater than the standard deduction for your filing status. Okay, so now that that is clear, let's start with one of the biggest tax breaks for homeowners, and that is the mortgage interest deduction. If you have a mortgage on your primary residence or even on a second home, you can usually deduct the interest that you pay each year on loans up to $750,000. So here's what that would look like. Let's say you paid $12,000 in interest this year. Depending on your tax bracket, that could reduce your tax liability by $2,500 or more. It's important to note that this only helps if you itemize your deductions. So again, if your total deductions are more than the standard, this benefit could be for you. Next up, property taxes. You can deduct up to $10,000 in combined state and local taxes, including what you pay in property tax. These are also known as SALT deductions. This cap of $10,000 remains in place for 2025 unless a new law is passed. Congress is expected to resolve this as a part of a broader tax legislation by mid to late 2025. So we'll see what happens there. If no deal is reached, the cap automatically expires after 2025, allowing a much larger SALT deduction starting in 2026. What this means for you, if you live in high state tax like New York, California, New Jersey, you've probably felt the impact of being limited to $10,000. If the cap is raised or expires, you may get significant tax relief because you can write off more of your property tax. If it stays capped, strategic planning like timing property tax payments may still help you. Again, you'll need to itemize to claim this. But when it's paired with your mortgage interest, it can really add up. Next on the list are energy efficient home improvements. Are you making your home more energy efficient? That's great news. There are credits for that. Things like solar panels, energy efficient windows, HVAC systems, even insulation upgrades may qualify. For example, under the Residential Clean Energy Credit, you can get a credit for 30% of the cost of eligible improvements. Not a deduction, but a dollar for dollar reduction of your tax bill. That's pretty huge. Before you buy, check the IRS guidelines or talk to a tax advisor to make sure your project qualifies. Now to the famous home office deduction. If you're self-employed or run a business from home, you might qualify for the home office deduction. This allows you to deduct a portion of your rent or mortgage, utilities, insurance, and even repairs based on the square footage of the area used exclusively for business. For example, if 10% of your home is used as an office, you could deduct 10% of those costs. But here's the catch. The law states it must be a dedicated space, not your kitchen table. And remember, this is for self-employed individuals where their primary place of work is their home, not W-2 employees working remotely. So what if you sell your home and make a profit? You might qualify to exclude up to $250,000 of that gain from tax, or $500,000 if you file married filing joint. To qualify, you need to have owned the home for at least 2 years and lived in it as your primary residence for 2 of the past 5 years. So if you bought your house for $300,000 and you sold it for $700,000, that $400,000 gain could be entirely tax-free if you're married and meet the requirements. As you can see, being a homeowner opens the door to some serious tax advantages, but not all of these apply automatically, and mistakes can be costly. That's where we come in. At Freedom Group, we help our clients maximize deductions, minimize taxes, and make smart financial decisions every single day. Need help figuring out which tax benefits apply to you? Just call and schedule a consultation with our team. The link is in the description. And if you're finding this helpful, please don't forget to like, subscribe, and hit the bell so you don't miss any future videos. Homeownership isn't just about building equity, it's about building opportunity. And when you understand how the tax code works in your favor, you can make smarter moves with your money. So whether you're planning on your next upgrade, selling your home, or launching a home-based business, we're here to help you get the most out of every decision. Ready to learn more? Watch our next video right here where we cover credits versus deductions, and we'll see you there.